So this week, what we talked about was current liabilities and payroll liabilities, how to record known liabilities. On July 15th, Piper Company sold $10,000 of merchandise, and that cost them $6,500 for cash. Now, the sales tax rate is 4%. Now, and then on August the 1st, Piper sent the sales tax that was collected from the state to the government. And so we're going to record both entries, the entry from the sale that happened on July the 15th, and then them sending the sales tax to the state. Of course, for our sales, we would debit cash the amount of $10,400 because that is the total that they received. Then you have to credit sales like we would ordinarily for $10,000. That's the amount that they sold the merchandise for. But remember, now we also have to credit sales tax payable $400, and that is the liability. That's 4% of $10,000, and that is the liability, okay, for the sales tax. Because remember, they don't, get to keep that sales tax money. They have to remit that to the state, and that causes a liability. So then we also then have to record the cost of the merchandise that was sold. And so on July the 15th, we had cost of goods sold. They told us $6,500 debit, credit merchandise inventory, $6,500. So we record the debit to cost of goods sold is the expense. And then we credit the merchandise inventory to remove that from our inventory. And we said merchandise inventory was an asset. And so then we have to clear the liability that was created for the sales tax. And so we would just do the opposite. So we would debit sales tax payable $400, and then we would credit cash $400. And then we'll look at another type of liability that's created. So on November the 3rd, the Milwaukee Bucks sold a 6-game pack of advance tickets for $300. Okay, so the advance, so these games, they've not been played yet. Okay, so on November the 20th, the Bucks played their first game of the 6-game pack. So that represented 1/6 of the advanced ticket sales. So we'll go ahead and record the entries for November 3rd and November the 20th. And so on November the 3rd, we received cash debit of $300. But when we have to credit unearned ticket revenue for $300 because we haven't played the games yet, and so that we still have a liability. We either have to play the games or would have to refund the money. And so then on November the 20th, they played their first game. So we have unearned ticket revenue debit for $50 because that's 1/6 of the $300. And then we would then be able to credit the ticket revenue $50 to account for notes payable. Sylvester Systems borrows $110,000 cash on May the 15th by signing a 60-day 12% $110,000 note. So on what day does the note mature? We can just look and we can count the dates. So we know that from May the 15th until the 31st, 16 days. See that May 31st to June 30th is 30 days, and then June the 30th to July the 14th is 14 days. So it's a 60-day note. We know that it would mature on July the 14th, and you can just look at the calendar and determine that. And so then and they tell us it's a 60-day note, and then to prepare the journal entry to record the issuance of the note. And so May the 15th, we received cash in the amount of $110,000. Okay, and then we had a liability for notes payable, $110,000. Okay, and we'll prepare the journal entry for the payment at maturity, so to figure out how much interest for that time period. And so we see that the principal was $110,000 multiplied by the rate, which is a 12% annual rate. But we're not doing it annually. We're doing it for 60 days. So 60 out of 360 we used 360 instead of 365. So they had interest for the period of $2,200. So to pay it, you would have notes payable debit 110,000, and then you would debit also the interest expense for 2,220, 2,200, and then cash for 112,200, because that's the amount of cash that is paid. The interest-bearing notes year-end adjustment, and that's when it goes into another year. The Keisha company borrows $200,000 of cash on November the 1st of the current year by signing a 90-day, 9%, $200,000 note. So first of all, we got to figure out when it would mature, and so 90 days. So we see that from November the 1st to the 30th, that's 29 days. November the 30th to December the 31st, so the year end, that brings us to 31 days in that period. And then December the 31st to January the 30th, that's 30 days, so that's 90 days. So it would mature on January the 30th. And that presents a problem because part of this, we have to record the expense of the interest for the prior year, and then we have to record then, and when we pay it, what goes into the following year. So we have to figure out the amount of interest that's recorded first in the current year and the following year. And again, we use 360 days in a year. So we can figure out that the interest for the period, or for 90 days total, is, so 90 out of 360 is $4,500. So 200,000 multiplied by the rate multiplied by the time. And so that's that. And so we see that for year one, the current year, that you have 60 days, and then you have 30 days of it going into the next year. And so within year one, the interest would be 3,000, and then what's going into the next year is 1,500. We can go ahead and prepare the journal entry for the issuance of the note. Would be a debit to cash for 200,000 because we're receiving cash, and then we would credit the notes payable 200,000 because that creates a liability. And then we can prepare the entry for the accrual of interest on December 31st, because we have to do that when we're closing out our books. So we have for the year, so we have interest expense. Again, it's going to be for 60 days. It's 3,000 debit, credit interest payable for 3,000. So that puts it into the as a liability. The liability, remember, will carry forward into the next year. The expense will stay with that year when we close that, do our closing entries. And so because we still owe the interest, we have to do that. And of course, we'll pay it at maturity in January. So then we'll go ahead and prepare the payment. So on January the 30th, we have notes payable of 200,000. We have the interest payable 3,000 debit, so debit for both of those. And then we have the interest expense of 1,500, and that's for the current year. And then we have cash we would pay of 204,500 total, because that's what we're paying out. Payroll taxes. We'll learn how to prepare our payroll taxes. BMX company has one employee. FICA Social Security taxes are 6.2% for the first 128,400 paid to its employee. And the FICA Medicare tax is 1.45% of gross pay. There's no cap on the Medicare taxes. Now, for BMX, its FUTA taxes are 0.60%, so 0.6%. And that is the unemployment for the federal portion. The state portion of unemployment or SUTA is 5.4% of the first 7,000 paid to its employee. To compute the amounts for each of the four taxes that are applied to the employee's gross earnings for September under these three different scenarios that are separate. So if we look at Situation A, we see that the FICA Social Security, the amount that was paid for September is $8,000. But if we look over here, we need to think about also what was paid prior and then what would be paid including that check, because that's going to affect the cap on our Social Security. So obviously the first two scenarios, we know we're not coming anywhere near that cap. So we see that $800 multiplied by 6.2% is $49.60. And so that's Social Security. And then Medicare, so 800 times 1.45 is 1160. And then our state, okay. And our federal unemployment would be based on $600. And the reason for that, because we're approaching the $7,000 cap on the federal unemployment. And so, right here, of the first 7,000. So 7,000. So 600 will bring us to 7,000 cumulative for the year. So then it's only 600 of that is subject to tax. So 600 multiplied by 0.6 is $3.60. Same thing for the state unemployment. So then it's going to be 600 times 5.4 is $32.40. Now, if we look at B now, we see then that after this check, $2,100, that the gross pay that this other person received would have been $4,100. So then we know all of it's going to be subject to tax, because we see here 7,000 is the cap, but through September the 30th, they would have been paid $7,200. So only 7,000 of that is subject to the unemployment tax. So we see here that, again, looking at B, again, $2,100 multiplied by 6.2% is $130.20. And then Medicare, $2,100 times 1.45 is $30.45. For the federal unemployment, $2,100 again, because they haven't earned 7,000 yet in the year. So all of it is subject to tax. Same thing with the state unemployment. Okay. Now, if we look at situation C, we see that the pay through August 31st is $122,100. And the gross pay they're getting for that month is $8,000. That's going to put them over the cap of this $128,400 for Social Security. So only part of it then is going to be for Social Security, and then also then you're not going to have to pay any more FUTA or SUTA taxes either, because it's over the 7,000. Okay, so only $6,300 of the 8,000 is subject to Social Security tax at 6.2%, so that's $390.60. All of the earnings are subject to Medicare, so $116. Now, you're not going to have to do either the state unemployment or the federal unemployment, because you've already paid that. You paid that probably, if they were getting $8,000 all along, you paid that in January.
And then for the tax rate, it's always like the same for every problem, right?
Yeah, so for our book, it will tell you what they are. I'll just pull this back up again. Yeah, for our book, it will tell you what they are. What I will say is, in real life, it is possible that these do change.
Okay.
Right, and so you have to then look up and find out what is the current Social Security, what is the current Medicare, and then for the, and also we said that for like the federal, it's actually higher, but it could be, they give you credit for the state. And so that's why in this case, the problem, it was only 0.60. It could be more.
Sense.
You'd have to pay attention to the problem.
Yeah.
But the caps are going to be the same again. So 128,400, these for the problems in our book, and then 7,000. But again, that could change periodically too.
Okay.
Because we know anything dealing with taxes, the IRS, all of that, it's always subject to change.
Okay.
And especially I shouldn't say, but especially right now with some of the things going on in the world. The one actually doing the actual journal entries for those. So BMX company, we said, has one employee. And again, the FICA Social Security taxes are 6.2% of the first 128,400 that are paid to the employee. And FICA Medicare taxes are 1.45% of the gross pay. And so for BMX, its FUTA taxes are 0.60 and SUTA taxes are 5.4% of the first 7,000 that are paid to the employee. So then we'll go ahead and prepare our employers September the 30th journal entry to record salary expense and its related payroll liabilities for this employee. The employee's federal income tax withheld by the employer are $80 for the period. So they're going to tell you that. Okay, so you don't have to calculate how much the federal income taxes are. So again, I'm not going to talk through this. I'm just going to pull this up, but this was what we looked at earlier. Okay. So the first entry would be a debit to salaries expense for $800 because that is the gross pay that they're being paid. And then we would credit the FICA Social Security taxes for $49.60, the FICA Medicare tax payable for $11.60, the employee federal income tax payable for $80, and then the salaries payable would be $658.80. Let me kind of talk to this. So what this is the amount that the employee is responsible for, and it also creates the liability for the salaries because we haven't paid and written the check yet for it. And all you do then is you would just debit the salaries payable, credit cash to pay it. So remember that for the employee, this is their portion. Now for the employer, they're going to have the same amount for the Social Security and the Medicare. And then they also, the employer, remember, is also the one that pays, and that's what we're going to look at next, is the one that pays the unemployment. The employee does not pay unemployment. Okay. And then the salaries payable, then that was what's left. Remember, the debits equal credits. That was the employee side. Let's look now at the employer side. I'm not going to read that, but this is now the employer's journal, the side of the journal entries. Then on September the 30th, we have payroll tax expense, and we'll get that total once we get all of the credits. And so we have the FICA Social Security tax payable of $49.60. Again, both the employee and the employer pay that. They pay the same amount. Okay. Now, just a side note, if you're self-employed, you actually have to pay both portions of that. Now, so the FICA, the FICA FICA Social Security is $49.60. The FICA Medicare is $11.60. $11.60. Then the FUTA tax payable, that's the federal unemployment, is $3.60. And the state unemployment is $32.40. And then once we have that, we can get the total then debit for the payroll tax expense of $97.20. So recording payroll. The following monthly data are taken from Ramirez Company on July the 31st. Sales salaries, $300,000. Office salaries, $60,000. Federal income tax withheld, $90,000. State income tax withheld of $20,000. Social Security tax withheld, $22,320. Medicare taxes withheld of $5,220. Medical insurance premiums of $7,000. Life insurance premiums of $4,000. Union dues deducted of $1,000. Salaries subject to unemployment taxes, $50,000. The employees pay 40% of medical and life insurance premiums. First of all, we got to figure out for how much of the medical and the life insurance the employees are responsible for. So the employee, we said, pays 40% of it. And I told you here the premiums were $7,000 for the medical, $4,000 for life. So the employee pays 40%, and so the remaining 60% is paid by the employer. And so we see that. And then the first thing we do is to prepare the journal entry to record accrued payroll, including employee deductions for July. So you have a debit for the sales salaries expense of $300,000, office salaries expense of $60,000, and then you have to then go ahead and list all of the liabilities. So those were the expenses, and we have the liabilities. So you have the FICA taxes. So again, $360,000 multiplied by 6.2% is $22,300, and I think they gave you that number, but they're showing you how to get it. And then the FICA Medicare is $5,000. Then the employee income tax withheld is $90,000. The state unemployment payable is $20,000. And then the medical insurance payable, again, $7,000 multiplied by 40% is $2,800. The employee life insurance payable, $4,000 times 40% is $1,600. The employee union dues payable is $1,000, and then the salaries payable, then what's remaining is $217,060. Now what we'll do is we'll go ahead and record the journal entry for the cash payment of the salaries that were payable for July. So on July the 31st, we have salaries payable, which that's the actual net of what the people are getting. So it's $217,060 debit, and then we'll credit cash $217,060. And then we'll go ahead. So that what we did before, let me back up. So this is going to be the employee side. And so this is what gets deducted from their check. Okay, so this is the employee side and what's deducted from their check. So now what we're going to do is going to be the employer side. Okay. So we have payroll tax expense. We'll determine that in a minute. And so we have the FICA Social Security taxes, because again, they're going to pay the same amount that the employees do for the, so $22,320 and $5,220 for credit for each of those. The employer also is responsible for paying the unemployment tax. And so we said state unemployment is at $50,000 is subject to it, at 5.4% is $2,700. And then the federal unemployment tax, again, $50,000 by 0.6 is $300. So that's payroll. Then this is the expenses. So we see employee benefits expense, the employee medical insurance payable, so $7,000 multiplied by the 60% that the employer covers is $4,200, and then employee life insurance payable, $4,000 by 60% is $2,400. Oh, and I forgot. And so what you do with the taxes is once you have them all established, you add them up. Your debit will be to payroll tax expense for that total, and then you'll credit those. Same thing with the employee benefits expense. Then we'll go ahead and prepare the journal entries for showing the cash payments for the liabilities. So then we just debit all of the payables. So again, the Social Security, the Medicare, the federal employee state income tax withheld, the employee medical insurance payable, the life insurance payable, the union dues payable, the state unemployment tax payable, and the federal unemployment tax payable. And you add all of them up and you'll credit for the total. Would be how you do it if you were doing it for all of your employees. So Mest Company has 9 employees. Again, FICA Social Security tax is 6.2 on the first 128,400 paid to each employee. FICA Medicare taxes are 1.45% of gross pay. So FUTA taxes are 0.6%. SUTA taxes are 5.4% of the first 7,000 paid to each employee. So the cumulative pay for the current year for each of the employees follows. Compute the amounts in this table for each employee and total the columns. So we'll see that for, again, the cumulative pay, then we see that for Ken, obviously he hasn't reached the max. Any of these haven't. Michelle, she has, so way over that. Michael, he hasn't yet, but Zach, he has. Lori, she did previous, and then Kitty, so we figure out that. Now, all of it is going to be subject to FICA Medicare, because Medicare doesn't have a cap. And then the state unemployment is 7,000. So we see Ken hasn't earned, he's only earned 6,000 yet, and John W. has only received 4,000 yet. And then the state unemployment is going to be the same thing, because it's only up to the first 7,000. And so then for the company, we'll compute the total of the FICA Social Security taxes, FICA Medicare taxes, FUTA taxes, SUTA. Now remember to include in the totals any employee share of taxes that the company will collect. See that for the FICA Social Security is 666,400. We get that right here. Times 6.2% is 41,316.80. Again, it's going to be the same for the employee and the employer portion. And then the same thing with the Medicare, but it's going to be, but Medicare doesn't have a cap, so it would be just the amount for the cumulative pay, which is 684,000. So 9,918, again, the same for each. And then the FUTA taxes is, again, would be 59,000. And then the state, so 59 times 0.6 is 354, and then 59,000 times 5.4 is 3,186. Warranties. The Hitzu company sold a copier that cost $4,800 for $6,000 cash with a 2-year parts warranty to a customer on August the 16th of year 1. Now, on January the 5th of year 2, the copier required on-site repairs that were completed that same day. The repairs cost $209 for materials taken from the repair parts inventory. These are the only repairs required for the copier. Hitzu expects warranty costs to be 4% of dollar sales. So to record the warranty expense with an adjusting entry on December 31st of year 1. So how much warranty expense does the company report in year 1 for the copier? So again, 4% of the 6,000 in sales equals warranty expenses of $240 in year 1. And then how much is the estimated warranty liability for the copier as of December 31st of year 1? So it would be, so in the first year, they didn't have any repairs, but they're expecting that they could have up to $240. So you have a debit balance and the estimated warranty liability for $240. Now for year 2, we did have a repair that had to be made of $209. So we have the liability that was from the previous year of December 31st of 2021 of $240, and then we had a repair in 2022 of $209. So if you subtract 209 from 240, then you have a liability in year 2 of $31. Now, real quick, let me just go back. So it's possible that there's two scenarios here. It's possible that for the remainder, because January, August, so I don't think, yeah, so the year hadn't ended yet. So it's possible that in year 2, it's possible that they could still have to go back and make another repair. It's also possible, another repair could possibly cost more than the $31. It's also, just a side note, it's also possible that it may not need any more repairs then. So just something just to be aware of, but their liability would be $31. Okay. And so then we'll prepare the journal entries for the copier sale. We receive cash in the amount of $6,000, sales credit in the amount of $6,000, cost of goods sold $4,800, merchandise inventory $4,800. So we debit cost of goods sold, which is the expense. We'll credit the inventory, merchandise inventory, because we're taking it out of inventory. Then we'll prepare the journal entry for the adjustment for the warranty expense. So we debit warranty expense $240, and then we'll credit the estimated warranty liability for $240. And then we'll prepare the journal entry to record the repairs that occurred in year 2. So you have estimated warranty liability of $209 debit, and then we'll credit the repair parts inventory of $209 for the parts that we used, that we took out of inventory. Computing and recording bonuses. For the year ended December 30th, Lopez Company implements an employee bonus program based on company net income, which the employees share equally. Lopez bonus expense is computed as $14,563. And so we have the employee bonus expense of $14,563. We have bonuses payable of $14,563. Now we'll prepare the later journal entry on January the 19th to record the actual payment of the bonus. And so we have bonuses payable debit of $14,563. That clears the liability, and then we'll credit cash $14,563 because we're paying cash out to our employees for their bonus. And then times interest earned. Remember, we said that times interest earned is the income before interest and taxes divided by the interest expense. If we do the first one, we see that the income before interest and taxes was $198,000, and then the interest expense is $44,000. So 4.5. So same thing here. Okay, so net income. So you'd have to add, remember, have to add back in the interest expense and the income taxes, and that's how we get that in an accounting for income tax. Nisshai Corporation prepares financial statements at each month end. As part of its accounting process, estimated income taxes, again, this is for corporate income taxes, are accrued each month for 30% of the current month's net income. The income taxes are paid in the first month of each quarter for the amount accrued in the prior quarter. The following information is available for the fourth quarter of the year. When tax computations are completed on January the 20th of the following year, NISI determines that the quarter's income tax payable account balance should be $28,300 on December 31st. Its unadjusted balance is $24,690. And so that is the amount of the net income, and then this is how much, 30% of it. Now, determine the amount of the accounting adjustment dated as of December 31st to get the correct ending balance in the income tax payable account. So we have income tax expense, 3610, income tax payable credit, 3610. And that is the difference between what the balance should be and what the balance is, and because it was short. And then we'll prepare the journal entry to record the later January the 20th payment of the fourth quarter taxes. So the income tax payable of $28,300, and then we'll credit cash the amount of $28,300. All right, gross and net pay computations. Lenny Forletta, an unmarried employee, works 48 hours in the week ended January the 12th. His pay rate is $14 an hour, and his wages have deductions for FICA, Social Security, FICA, Medicare, federal income tax. He claims 2 withholding allowances. Compute his regular pay, overtime pay. Lenny earns $21 per hour for each hour over the 40, and gross pay. Then compute his FICA tax deduction, use 6.2% for the Social Security portion, 1.45% for Medicare. The income tax deduction, use the wage bracket withholding table in Exhibit 11A.6. Total deductions and net pay. So we see his regular pay, 40 hours at $14 an hour, is $560. And then his overtime pay for 8 hours at $21 an hour is $168. So his gross pay is going to be $728 for the week. And then he had FICA taxes, 6.2% of the $720 is $45. 728 is $48.14. The Medicare again. And then if we look on the exhibit and we find out he had 728, so it would have put it right here, and it said he had, let me get the highlighter. I think that's right. And so if you look, you said he had 2 allowances. So if you look over, you see the number of allowances claimed. So you see the amount of wages and then the amount, and just line it up. So that's how we get 76. Then his total deductions then are $131.70. So net pay, if you subtract that from the gross pay, comes out to $596.30. Last one, doing the payroll register. Start company has 5 employees. Employees paid by the hour earn $10 per hour for the regular $40 work week and $15 per hour beyond the 40-hour work per week. Hourly employees are paid every 2 weeks, but salaried employees are paid monthly on the last biweekly payday for each month. FICA taxes 6.2% of the first $128,400 paid for each employee. Medicare, FICA Medicare taxes 1.45% of the total gross pay. Food taxes are 0.6%. SUTA taxes are 5.4% of the first $7,000 paid for each employee. The company has a benefits plan that includes medical insurance, life insurance, retirement funding for employees. Under this plan, employees must contribute 5% of their gross income as a payroll withholding, which the company matches with double the amount for the portion of the retirement. Following is the partial completed payroll register for the biweekly period ended August the 31st, which is the last payday of August. Complete the payroll register by filling in all of the cells for the pay period ending August 31st. So the first one we'll look at is Kathleen. So for her, she's exceeded the $7,000 a year, so she's not going to have any, because the cumulative, excluding the period, she will have exceeded that, or she already exceeded the 7,000. And then the portion of that that's subject to FICA taxes, again, just multiplying and then subtract. So that's how you get that. And so again, and then you can just total. So then we have the totals, and then we'll prepare the August 31st journal entry to record the accrued biweekly payroll and the related liabilities for deduction. So we have salaries expense of $10,020, and then we'll credit the employee federal income tax payable of $23.80, the employee state income tax payable of 388, FICA, and this is going to be for the employee portion. So we have employee, all this, and then employee, their portion of it, and then the salaries payable then of 6,306.87. So that would be the net pay for the employees. And then to actually pay it, you have salaries payable 6,306.87 debit, credit cash for that amount.